where we will be we'll be giving you guys more information and the link to apply. So with that, I'd like to say this team is in a very unique position, not only because they are the first Cal Poly team to be defending their first place prize, but also because of the unprecedented challenges that we all faced. So congrats to them. We're really happy to be hosting them. And with that, I will hand it over to Professor Tom Korea to give any final remarks while everyone gets ready to present.
All right. Hey, Brian, thank you. Hi, everybody. First of all, I want to thank the SMIC Club for allowing us to do this and use you guys as the guinea pigs. We really appreciate that. I actually want to make a quick comment about this club itself. You know, from where we started, where we're just a ragtag trying to figure out what we want to do, to today, it's a tremendous progress by the club, the level of professionalism, the level of organization, the level of intellectual content in the meetings. It's a very, very impressive. And, you know, I think it's a lot of work. Is credit goes to the alums led by Brian as our president here. So I think it's really kudos to the club for what you guys have accomplished. I want to again thank the faculty as well, like Brian said. We look at all of everybody here as a family, so we look forward to your support and help and challenges to prepare our team. We're very proud of the program. I think Dr. Yu will agree with this. We look at it as part of as a flagship program within the FRL. If you, for the students, if you find what we're about to present exciting, I would strongly encourage you to apply for the spring semester. It's one thing I can guarantee you is you'll work hard, but the other thing I guarantee you is what you will learn will be amazing. You will just be amazed at what you learn in this class. So I encourage you to apply. The apps are still open. The current class had 16 students, but they've also been helped by a lot of our alums. You see many of them in this meeting. So the work that you're about to see is really the combination of all these people's efforts, not just the students that are in the class right now, but also the alums. While everybody has helped, you'll only see 7 people actually present, just in the interest of logistics. But remember that this was a team effort, and all of the current students and the alums have had a big part in it. I just want to say personally, I can't tell you how appreciative I am of what the alums have contributed and how hard the students have worked on this. I never treat this class as another class. I treat it as just part of my team, and we're all working together. And that's the highest level of respect I can give to the students, is to treat you as equal to me and me as equal to you. And you have my ultimate appreciation for that. And I mean that from the heart. I really, really appreciate it. Finally, I want to recognize this team. They have worked very hard during the semester, have learned a lot, and have also taught me a lot. Hopefully, as you watch their presentation, that will come through. And I think you'll be impressed. Feel free to challenge them, though. They need the training for the competition. With that, I'm going to turn it over to Alex, who's going to start us off.
Yeah, if you can allow me to screen share, Brian, and we can kick off the presentation. Co-host will do, no big deal. There we go. Thank you. Give me a second. Oh, we don't want the thank you. Hold on. Okay, what's that? All right, whenever you're ready, Alex.
Awesome. Yeah, thank you. Thank you, everybody. Thank you for that, Brian, Professor. We appreciate it. So hi, everyone. My name is Alex with Bronco Asset Management. We want to thank you for this opportunity to present our proposed portfolio. So we'll start by telling you a little bit about who we are and how we operate here at BAM. Yeah, so here we have our team. As Professor said, only 7 of us are going to be presenting to you today, but everyone you're seeing on this slide contributed a whole lot to the creation of the portfolio. Before we get into what we're proposing for 2021, though, we wanted to give you an update about where we are in 2020, since we do have the honor of managing the current CFA OC portfolio right now.
Is there some lag on my end?
There might be, yeah. I'm seeing the presentation maybe a little bit slower, so I apologize for that. But anyway, so our current portfolio for you this year is actually it's outperforming the benchmark, and we think that the biggest driver of our outperformance has been the underweighting to international markets relative to the benchmark. We have seen a little bit of drag from our sector allocations, but we feel our stock screening process, our market timing, etc., has actually worked out pretty favorably for us. 2 other factors that have been pretty beneficial are the stop limits we imposed on the portfolio, which shielded us from the volatility in March, and our ability to quickly reinvest those stopped out positions into sector ETFs to stay invested, which allowed us to take advantage of the recovery. On the bottom of the slide here, we've included Regeneron as an example of an outperforming stock and Performance Food Group as an example of an underperforming stock for the listed reasons. So that's how we've done right now. Let me shift now into what we're proposing for the coming year. So our management is guided by our investment philosophy, which is outlined here in front of you. So I'll just quickly touch on a couple main points. So we start by putting the client's needs and expectations first. We're fundamentally driven. We focus on maximizing risk-adjusted returns. And most importantly, we're committed to you and your success. And so we make sure everything that we do is done ethically, competently, and diligently. So our construction process, like everything we do, starts with your goals. From there, it can really be broken up into 3 main components. So we have big picture analysis of historical and future expected returns and outcomes based on fundamental economic factors. We use these projections to optimize for risk-adjusted returns and set our strategic asset allocations. In the next component, we take each of these asset classes from the first phase. We try to dig a little bit deeper to find out what the proper strategy is given the goal of each asset class within the portfolio. And then the last component is all about picking the securities, monitoring and rebalancing the portfolio, and frequently reviewing all of these things with you. So we'll take a closer look now at the first step of the construction process and talk about your goals as we see them. So the target return was found to be about 8%. While this is the goal, and taking a look at the benchmark outlined in the RFP, we can see that its expected return is significantly lower. On the slide here, you'll see that the portfolio that we're proposing should earn above 6% without taking on an unreasonable amount of risk. So we'll dig a little bit deeper into this and how we built the portfolio in the following slides, but I'm going to turn it over to Adam for now, who's going to be walking you through our historical and future perspectives.
Thank you, Alex. So we began by looking at how 5 major asset classes performed historically over 20 years, and then the most recent 5 years. As you can see, historical returns have been very strong, especially in the US. This has been driven partly by a 30-year trend of declining rates, supporting equity and fixed income valuations. Looking at what we might expect in the future, we start by analyzing the global economy. First of all, you see there are 2 major events that will affect the global economy. First, the worldwide impact of COVID is undeniable, but it is our view that the substantial global efforts will be successful in finding a vaccine and that it will be widely available by summer 2021. The other major event is the US election. We believe conclusion of the election will provide more stability both domestically and globally and allow for further fiscal stimulus, albeit smaller in size. In combination, the above factors will aid in an economic recovery. To assess this recovery, let us dig deeper into what we actually see as a US economic outlook. The graph on the left shows the substantial impact of the pandemic in Q1 and Q2 and strong bounce back in Q3. With vaccine availability and the election over, this bounce back is expected to continue through 2021 and 22. Beyond 22, we do see a slower rate of growth more consistent with economic trends that were in place pre-COVID. The continuous decline of interest rates shown in the graph on the right side and additional monetary stimulus by the Fed have also supported the recovery. However, while the Fed will keep short rates near zero, we feel a stronger economy will lead to a bottoming in long-term rates. Other data supporting the recovery outlook include bounce back in the PMI SMI, increases in consumer spending, including year-over-year growth, and strength in housing, as shown here. Given low mortgage rates and expectation of further fiscal stimulus, spending and housing should remain supportive. The US dollar is also an important factor that affects our investment decisions. In early 2020, as the pandemic hit, we saw a global flight to safety to the dollar. However, this strength did not last as zero rates, divisiveness, and questionable responses to COVID reduced confidence. And the dollar is expected to weaken further by about 2% by the end of 2021. We believe this dollar weakness may reduce foreign demand for US debt, thus further supporting our outlook of rising long-term rates. In summary, the combination of a vaccine, conclusion of the election, and fiscal and monetary stimulus will lead to continued strong recovery in the US. Now, Wendy will review economies outside the US.
Great job, Adam. Thank you. After we looked at the US economy, we went ahead and looked at how the rest of the world is faring. First, I'll cover some countries that we foresee as having a negative outlook the next couple of years, and then I'll move forward with a more positive forecast. Brazil, European Union, India, and Japan all have weak and negative outlooks. Specifically, when we look at Brazil and India, their economies are still suffering due to poor management of the pandemic and continued political instability. The main deterrents for European Union and Japan are low GDP growth despite substantial monetary and fiscal stimulus. Furthermore, Japan's economy suffers from demographics of declining and aging population. Since the slow recovery and weak economic outlook are anticipated for these countries, we do not recommend investing in these parts of the world. Moving forward, these are 4 countries we observed as having a positive outlook. As we researched China, we really like their story. They're the only large economy with a positive GDP growth after COVID, and it's expected that in 2022, the Chinese economy will grow 15% from 2019. One of the main drivers for China is their switch from a manufacturing and export-based economy to a more consumption and service-based system. Rapid growth towards digitization and high-tech innovation has greatly benefited China. A Biden presidency will also lessen the tensions on the trade war. The economies of Taiwan, Hong Kong, and South Korea are highly correlated with the Chinese economy and will all be major beneficiaries of China's growth. Also, South Korea benefits from a tech-driven economy and fiscal stimulus. And now Sandra will share our strategic asset allocation.
Thank you, Wendy. 3 broad themes drive our strategic asset allocations: economic fundamentals, low expectations in fixed income, and geographic diversification. Our allocations were also optimized for maximizing returns without undue risk. The result is 65% in domestic equities, 15% in emerging markets, and 20% in fixed income. Now that we've talked about our allocations, let me expand on our strategy. In domestic equities, BAM is following a value and reasonable growth strategy. As you will see in our RFP, our research shows that while value has significantly outperformed growth over the long term, the trend has reversed in a dramatic way since 2018. We think this is an indication of excessive optimism on growth. The issue is not that value has done poorly, but rather that growth has performed unusually well, as shown by the table here based on research by Dimensional Advisors. Moving on, I'd like to talk about why growth has outperformed so well. In our opinion, there are 3 reasons: low interest rates, dramatic increase in valuation, and economic shift towards virtual activities. Looking forward, we see a reversion of these factors due to interest rates bottoming out, wide vaccine availability, and normalization of growth valuation. So, our strategy is to prioritize value while still looking for growing companies. Let me talk about how we apply this in our sector allocation. Driven by our economic outlook, we reviewed the performance of each sector displayed here. We then over and underweighted each relative to the benchmark. For example, we underweighted technology due to overvaluation and shifted that weight to a more promising healthcare sector. Now I'll hand it over to Colin to discuss our domestic security selection.
Thank you, Sandra. Now, as Sandra just explained, we are employing a value and reasonable growth strategy when it comes to our equity. Once we determine our sector allocations, we select individual securities by utilizing the 4-step process laid out here on this slide, which we're going to walk through now. First thing we do is we screen for all U.S. securities and common stocks based on these 8 criteria. We start with the CFAOC guideline of above $1 billion market cap. We want to focus on a couple things here. Gross profit to total asset ratio, for one, based on academic research, we believe highlights companies that outperform. The other thing we want to touch on is when we are considering growth, we bypass 2020 because it's so unusual. We compare 2021 revenue to 19, and what we're trying to do is to find companies that come out of the pandemic stronger. So we go through the screen and we get a number of securities that come out, and we move to the second phase of our process where we run them through the BAM 13. There are 13 criteria that we judge a company on. We are looking for growing businesses, improving profitability and efficiency. I'd like to direct your attention to the 12th metric, governance score, because it really demonstrates BAM's proprietary research. As you'll see in our RFP, after controlling for sector and market cap, we found firms with better governance scores tend to outperform. In the third step of our process, we do a quantitative and qualitative analysis. We look at research reports, we view management presentations, and we listen to earnings calls. And we finalize our process in step 4 by constructing DCF and DGM models in order to arrive at an intrinsic value per share. And so these are the analysis that we do to pick individual stocks. And now I want to walk you through one of the stocks that we really like that we picked, and one stock that just did not make the grade. So a stock that we liked is Meritage Homes. We think the industry environment with low rates, high demand, is very supportive. And we believe the company is well positioned, being focused on the first-time home buyer and in a strong financial position. Lastly, our DCF valuation tells us the stock is undervalued and fits with our value approach. Next is a stock that we didn't like so much, WWE. It is overvalued in our opinion. We also think that the fundamentals are not very strong for this company, and neither is the environment, considering the pandemic. Lastly, we had some concerns about corporate governance. Now I'd like to turn it over to Wendy to discuss our emerging markets allocation.
Awesome, Colin. Thank you. For a diversification strategy, BAM has decided it's appropriate to invest 15% of our portfolio into emerging markets. As I mentioned earlier, we really like China's story, especially their 15% positive growth forecasted in 2022. We anticipate a weak dollar, so this will directly benefit these ETFs because historically when the dollar is weak, emerging markets have outperformed their benchmark. China carries the leading role in emerging markets, so we allocated 58% to Wisdom Tree. And within China, we avoided government-sponsored companies as we feel these companies are more politically driven rather than profit-driven. And now Ethan will share our fixed income strategy.
Thanks, Wendy. So how did we allocate the fixed income portion of our portfolio? First of all, we have low expectations of fixed income. And let me explain what we mean by this. Right now, interest rates are extremely low, so there's practically no yield. But in addition, as economic recovery pushes rates up, bond investments might actually yield negative returns. Thus, our focus in fixed income shifts to offsetting equity risk. And so overall, we didn't want to allocate a lot to fixed income, but we thought that some allocation was still necessary. Digging a little deeper, we created 3 goals for our fixed income portfolio. Our first goal was capital preservation by avoiding negative interest rates or negative returns due to rising interest rates. And we just want to be able to keep our money as safe as possible. Our second goal was that we wanted protection in case the economy worsens. We wanted to prepare for this possibility, even though we're forecasting a vaccine-driven recovery. And finally, our last goal is to achieve some income with our bond portfolio. And after considering these goals, here are the securities that we selected for our 20% allocation to fixed income. We decided to invest 10% into an aggregate US Treasury ETF and 10% into a short-term corporate bond ETF. With the US Treasury ETF, we get diversification into both short-term bonds, which are better at preserving capital, and long-term bonds, which are better at providing protection because of their higher duration. For the short-term corporate bond ETF, we chose short-term because it's the most resistant to rising interest rates, and we chose corporate because this would help us to achieve our last goal of gaining some income since they have higher rates than treasuries. Also, with the US economic recovery from COVID, we anticipate that there will be less default risk, making the investment somewhat safer. And now I'll pass it off to Andrew to talk about how we'll manage this portfolio.
Thank you, Ethan. So here we outline BAM's 4 main components to our portfolio strategy. We monitor continuously, manage risk, rebalance as necessary, and most importantly, communicate with the client. So by making communication our centermost priority, we ensure that returns, portfolio activity, or even our market outlook remain fully disclosed. So now, of course, the moment we have all been waiting for. So our final breakdown consists of BAM's blended 65, 15, and 20% allocations to equity and fixed income. So let's translate these allocations into numbers in terms of the portfolio. So relative to benchmark, our portfolio can deliver a higher return of about 6.5%, a little bit higher standard deviation of 12.39%, but still well within manageable means, portfolio beta of 1.03, and a notably higher Sharpe ratio of 0.52. So now we do realize that a 6.5% return is not meeting the required return of 8%. So, if you think it's too low, we could seek higher beta stocks. And if you think it's a bit too aggressive because of our 80% equity allocation, we could move 10% of our emerging market allocation to short-term corporate bonds. But this would decrease the expected return to about 5.9%. So realistically, given the client profile, we do believe this strategy is right for the client. So let's put numbers aside for a second and emphasize that BAM is a client-first firm. We add value through our fundamental approach, and we remain flexible by reacting to ever-changing market events like seen in 2020, and of course, going into 2021. So we hope the client, of course, finds our work attractive, well-constructed, and substantially valuable. As managing director on behalf of Bronco Asset Management, we thank you for the opportunity and hope to continue our partnership and keep the CFAOC as our valued client. Thanks, everybody.
All right, so to moderate that, if the judges have any questions, please feel free to mute yourselves and ask them freely. And if you are in the audience, if you could type up your questions in the chat and we would try to get to them afterwards. Great presentation.
Brian, can you hear me?
Yes.
Yeah,
Yes.
can I ask some questions? First of all, great presentation. The presentation flows very well. And I also was very impressed with the synchronizing of these slides versus the presentation. So good job, well done. I have a couple of questions. Number one is regarding this Sharpe ratio. How did you calculate the Sharpe ratio? Isn't that the excess return over the standard deviation? In the last few slides, you calculate the Sharpe ratio for the BAM portfolio to be 0.52. Did you calculate it as the return of the portfolio divided by the standard deviation or the excess return of the standard deviation?
We calculated the Sharpe ratio based on the expected return over the standard deviation.
Expected. So it's not excessive.
No.
Yeah, and to note, the portfolio beta is on top of that is calculated with the with only the equity portion. I know that we had to clear that up, but yeah.
Yeah, did you subtract the risk-free rate?
No, we did not.
So I have a question because currently the SPDR index fund Sharpe ratio is 0.71 and your portfolio Sharpe ratio 0.52, and that seems to be significantly lower than the index fund Sharpe ratio. I understand this is an expected Sharpe ratio, but how did you justify that Sharpe ratio compared to the index Sharpe ratio?
So I would say we justify that by, so you're talking about the S&P 500?
Mm-hmm.
Yeah, so the S&P 500 does not include emerging markets. So our allocation to emerging markets, we will take on a little more risk there.
Okay, so another question is your allocation for the international equity. So you have the 58%, 5%, 18%, 19%. How did you come up with those weights? Is there any particular reason?
Yes, we went by the MSCI index. So we just duplicated their percentages based from that MSCI index. It's proportionate.
Yeah, but what we did was because the emerging markets index also includes countries other than the ones we listed, we only focused on the ones we listed, so China, Hong Kong, Taiwan. And so we took the percentages of those countries that we didn't want to invest in and we allocated them to the countries that we were going to invest into. So it's based off of the MSCI, but with reallocated percentages.
Can I ask which MSCI?
The MSCI Emerging Markets Index.
Okay.
A couple questions. So a lot of your framework is based around the value premium, which historically has existed, but in recent years hasn't performed as well. You explained why you thought that growth stocks have performed well, but they won't going forward. But can you explain a little bit about why you think the value premium exists at all? It's kind of a controversial thing. People don't know exactly agree on why it's there. If you think it's going to continue in the future, it'd be helpful to understand why it exists in the first place.
Yeah, so going over, I think, we based this portion of our research off the Fama French model of growth, and also the dimensional fund advisors, and how we found the sustainability of value historically as a key driver of why we believe that growth will, it will kind of it's the current overperformance indicates an underperformance in the future based off historical returns. And if we know anything about value, is its sustainability historically, and also in current overreactive growth trends like we're seeing now.
Okay. Another question is, you mentioned Meritage, a housing company, a home builder. I'm curious about if you're at all worried about some of the negative factors in the housing market. It's growing really well right now, but it's becoming increasingly unaffordable in a lot of large cities. And a lot of people are concerned that a lot of cities won't let home builders build as much as they want to. A lot of land use regulations in high demand cities like Los Angeles. So can you explain why you think those things aren't going to prevent Meritage from performing as well as you think they will?
Well, so I can answer that. So we did want exposure to this specific industry, and I mean, you make a really good point. It is possible that we see some backlash from the rapid appreciation in certain areas. But I think one of the things that we really liked about Meritage is that they're in a really strong financial position. So we think that if there is some kind of backlash, that they would be able to properly weather that storm over other companies maybe in this industry.
Okay. One question about your international exposure. Most of your international exposure is pretty much concentrated on Asia. I understand the argument for China. They've obviously emerged from the pandemic better than most countries. One thing that you kind of skirt over that you refer to in both the report and a PowerPoint slide that I do want to ask about, though, is that you say that China's involvement in Hong Kong is a positive thing. China's doing well, therefore Hong Kong will do well. A lot of people see China's intervention in Hong Kong as stifling free markets and possibly being damaging to the long-term growth trend. So why are you exposing yourself so much to Hong Kong with the potential for these political problems?
Well, we did say on that slide that we really do expect the political instability to subside a little bit, and I think that would probably be part of our reasoning.
Yeah, and to add on to that, I don't think that we acknowledge that there is political instability and that it has been an issue in the past. But what we see is that the economy of China coming back so quickly and so strong in 2021, it's going to have overspill into those other 4 or the other 3 additional emerging markets that we're looking into. We do acknowledge that there might be issues with political instability there. However, with the portion of our emerging markets that's allocated to that, and the overall percent of the portfolio, it's 5% of our emerging market. So it comes out to just under 1% of our entire portfolio. We do feel that the benefits are going to outweigh the risks in that situation.
One last question, and then I know I'm probably keeping Professor Mudasev from wanting to ask his questions. So one last question.
Okay, go ahead.
In your domestic economic forecast, you pretty much agree with forecasters that inflation is going to remain pretty low and stable into the long run. But there's one big problem that could prevent that. The budget deficit, the federal budget deficit is massive. It's unprecedented. Are you at all concerned that that could push up inflation in the years to come?
I mean, that's obviously a factor, but I think what we've seen especially like not just in the last decade, but in recent years, is we do have a Federal Reserve who's proved that they really are willing to do just about anything to manage these types of risk and to do like monetary stimulus. So I think that perhaps we're maybe leaning on the Fed a little bit there to manage that inflation risk. But obviously, the budget deficit is a concern in that aspect. But I think we are relying on the Fed a little bit there.
Sorry, one last follow-up to that then. The Fed has said that they're going to keep interest rates low for the long term, no matter what happens. Now, not everybody believes them, but if inflation gets out of control, they'd have to go back on their word. You're suggesting that you think that they will go back on their word. Even though they said they'll keep interest rates low, if inflation gets out of control, they will basically violate what they promised to do.
I think if inflation becomes a serious issue, I think yes. I think that what they're trying to do is really manage the worst problem. So if inflation becomes a serious risk, I think they would probably manage that. Yeah.
And I think to add on to that, I think the Fed does work in our best interests. As difficult as it is to conceive that sometimes, they do in fact work in the best interest and probably take the path of least consequence.
All right, I would like to ask a question about your. You selected two government securities ETFs. Why those? Did you consider any alternatives? For example, I mean, highly rated corporate bonds, where the risk is minimal and you still can pick up some yield.
You're talking about the fixed income portion, right?
Exactly, yes.
Yeah, so we allocated 10% into government and then 10% into short-term corporate. So there's 10% into government. So it's not entirely all government, but we did consider the alternatives. Like say, for example, you said the investment grade, like higher yield corporate. Is that what you said?
Yes, yeah.
Yes. So we agree with you. We think that corporate is going to give us some of that income and that investment grade is going to be really good. And so we are allocating into short-term investment grade corporate bond ETF. And again, we chose short-term because we want to, so short-term is going to be the least resistant to rising interest rates. And so we thought that was the best place to go into given the current condition we're in.
What does short-term mean and what are the rates on those?
Yeah, so short-term in the actual ETF itself, it's going to go anywhere from 0 to 5. And so it's going to be within that area. But we think that it's not like going to be T-bills where it's less than 1 year, but it's 0 to 5.
But again, the ratio, for the 0 to 2 or 3, the ratio will be very low, 0.1 or 0.2%, something like, or less than 1%. So I guess you can pick up some yield if you go up the maturity.
Mm-hmm. Yeah, so we also considered like intermediate corporate and long-term corporate as well. But again, with the evidence that we found with potential rising interest rates, there's a huge downside to if interest rates were to rise by just say 1%, if we had invested into a long-term and into an intermediate. So overall, our outlook into the bond market was that most likely we're going to have negative yields with a lot of the like lower yield bonds. And so by going into short term, we're going to mitigate that as much as possible.
So, Ethan, so on the one hand, you're predicting a rising interest rate, and that's why you are choosing the short-term corporate with lower duration. But on the other hand, you are choosing the longer-term treasury security. So will there be some conflict between the two objectives here?
We think that through doing that, we're more so diversifying our fixed income a little bit. I looked into the government bond ETF as well, and I looked 70% of that is from 0 to 5. And so a majority is going to be short-term and intermediate with the 30% into the longer terms. And we wanted to do long terms because even though we're forecasting rising interest rates, we still wanted to prepare for the unlikely possibility that interest rates, that maybe we're going to see another wave of this pandemic. Maybe they're going to lower interest rates just a little bit more. And so we wanted some type of protection into that. So instead of allocating directly into a long-term bond ETF, we wanted to go into ETF that diversified into both short-term, intermediate, and long-term.
What is the duration of the government bond ETF?
7, like around 7.
And also, what do you mean by protection through duration in one of your slides?
I'm sorry?
I think when you presented the fixed income portion, you mentioned protection through duration.
Yes, so with the duration, because we're going to have a higher duration through that government bond ETF, if the interest rates were to drop, as we're saying like they might, then we're going to have, with a higher duration, you're going to have more upside compared to something with a shorter duration. And so with the corporate bond ETF, we're going to have the shorter duration, but higher yield. And with the government, we're going to have a higher duration, but it's safer, and there's going to be a little bit less yield.
Okay. Thank you.
Can you go back to one of the slides when you talk about value versus growth? It was used earlier, please. When you talk about why, maybe the one after that. You know, where were you? Yeah, here. Okay, the one after. What happened?
It's a bit laggy, young man. Do you want to see the value premium specifically?
Slide number, I guess 21. Is that what it is? Okay.
Slide 21.
Yeah, I think yes.
Okay. Okay. Here you go. Sorry about that.
So it's about value versus growth. Okay. So explaining why is I think the growth performed different from valuation, from value. But you see, you explain it, I don't know how, a dramatic increase in valuation. Isn't that what you're trying to explain? I thought I was not comfortable with this here. So 3 count trends, okay. Okay, one of them is the dramatic increase in valuation. So you're using valuation to explain appreciation, and I was not comfortable with this.
Are you referring to the wording, valuation over appreciation?
Yeah. So okay, one more time, explain what you're trying to say here, please, on the slide.
Right, so on this slide, we just basically gave our reasoning for why we believe value versus growth. So it was, in our opinion, 3 reasons: the low interest rates, the dramatic increase in valuation, and economic shift towards virtual activities. And then based on our research and looking forward, we see that there's going to be a reversion of these factors due to the 3 reasons you see below, which are interest rates bottoming out, wide vaccine availability, and normalization of growth valuation.
Okay, so, okay, so you're saying going forward there'll be the prices are expected to go up. Is that what you're saying? Yeah, by saying dramatic going forward, stock prices to increase.
I think that what we're trying to say with this is that currently there has been a dramatic increase in like valuation of
or appreciation, as you would say. Yeah, and so there's been a massive appreciation in growth stocks, and we think that it represents a short-term inefficiency, as we're putting on the slide. So like that's why we're kind of pitching our horse more towards value, because we think that there's going to be a reversion to that.
But I guess I guess what's here, isn't the increase in valuation equal to appreciation?
Yeah, that's what that slide means. So there's a dramatic increase in appreciation, price appreciation. Yes.
For growth stocks.
For growth stocks, correct.
Okay. Okay. So fine.
All right, so if there's no more questions from the judges, and you feel free to ask more questions. Oh, we have Professor Kashefi if you have any questions. We have a question from John Oliver, past MD. John, Did you want to unmute yourself and ask it?
Yeah, sure. Just want to say great presentation, guys. But as I mentioned in the chat, you guys mentioned that you believe long-term rates will be you said bottoming out, but that you're also going to expect them to be going up as the economy continues to recover. Can you just clarify what you guys, what your stance is on long-term rates relative to short-term? I just feel like there might be some confusion there.
Yeah, so thank you for that. So we're saying that the interest rates are currently like bottoming out. We're predicting that we don't imagine that they're going to go lower than what they're at. And so in the long term, we do see them rising. So we do see that the short-term rates are hitting their lows, and so therefore long-term rates are going to be rising going forward.
Okay. I would just make that clear, because when I heard long-term rates bottoming out, it sounded a little contradictory to, they're going to be going up though in the future. And then the other question that I mentioned was on your fixed income slide. If we could go to that one, there were 3 goals there. One of them was some income, and then 2 was 2 of them were both practically capital preservation, no? And just kind of worded differently.
Yeah, so I understand your point. The way we phrased it is with capital preservation, our goal with that is basically avoiding negative interest or negative returns and keeping our money, basically. So that's keeping our money with protection against further economic downturn. That purpose was that, okay, so say the economy goes down, we're going to get upside with that goal. And so we're achieving that through long-term bonds because of their higher maturities. So protection is going to be like you get some upside. Capital preservation is just keeping as much of your money safe as possible.
Okay. Now, you believe there's going to be upside. I mean, what kind of upside, if you guys think that rates are bottoming out and that they're only going to go up, like long-term rates, wouldn't that decrease the value of your bond portfolio?
So so you said that if interest rates were to go up, it would, okay, yeah. So yes, that's why we're saying we're predicting rising interest rates. And so with short terms, although it's going to affect bonds poorly, with short-term ones, it's going to affect it less so. And although they're going to go, if they do go up, it's going to affect long-term even more. That's why we're just allocating a smaller percentage to it, just for that unlikely possibility. Like I said before, I think it was like 30% of the government ETF is going to be long-term. And so 30% of like 10%, that's about like 3% of our portfolio. So it's not a whole bunch, but in the upside that, and in the case that interest rates do go down, then we're going to have the upside.
Okay. Yeah, just, yeah, I mean, I would just kind of be prepared for that.
Could I ask that question now? Yes, I can imagine Judge asking me this question at the end as well. Now you've done a great job. Thank you so much. We really enjoyed the presentation. Can you give us reassurance that the remaining members of the team and the incoming members of the team would deliver just as an excellent performance as you had done in last semester or period? So why should we stay with you?
I think something that is very unique to Cal Poly Pomona is that we start from scratch, and we have such a very strong alum presence that kind of is always present in each incoming class, and we're growing such that we're building off everybody else coming in and coaching us and building off that. Of course, we have Tom Corey as our advisor to be the mediator of such discussion. But in a way, not only are we outputting every single year a lot of new, fresh minds, we're also building off strategies of the past. And, if you ask us, we'll make a better one every single year.
I think I may ask, what do you do specifically?
What do we do specifically in terms of?
Improving, the strategy, delivering better performance. That's what this is all about, right?
Yeah. If I could stab at this, Andrew, I think that what we have is a very supportive system set up in like under BAM. So we do have the student managed investment fund, but we also have the club here today. The idea is that the club kind of like introduces students to concepts so that when they transition over to the actual investment fund class, it's a smoother transition. And what it does is it kind of creates like this alumni network that Andrew was talking about, that it's not only like a very strong alumni network, but it's also very connected to the current class and potential classes coming up. So what happens is students are kind of, you don't graduate and then you're done and then you kind of join the alumni. Like it's a large group of people that we are already like kind of meeting them, we're talking to them, there's a lot of communication. So what I feel is that specifically the presence of the club itself kind of mediates that transitionary period for students once they're done with the actual class.
Can I suggest a couple of things for you? We could talk about the experience of the team under the wonderful leadership of my wonderful friend, Pawan. And that's one. And also, if there's some alumni who actually graduated and ended up with good jobs, kind of point them out. Philip did this, Mary did that, and saying they work for this company, that company, or this person passed CFA level 1, we're still in touch with them. That will show the caliber of the people that are coming into the team and graduating from it.
Yes, thank you for that.
That's what I'm here for.
Great. So I know Professor Welke and Professor Cash, if you would like to ask a question, feel free.
So I thought we agreed we won't let Cash ask questions, Brian.
I just had a very generic question about exit strategy.
Yes,
Sorry.
Professor Welke, go ahead.
I just had a very general question about whether you have an exit strategy for high duration bonds. So if there's a strong economic recovery, you'd expect the long end to rapidly start rising. Is there a set of conditions that would allow you to predict that? Is there a signal that you have that says time to lighten up on the high duration stuff?
So we haven't formally developed one, but as an active managing team, we are definitely going to be monitoring the market conditions as we go along. And so we can maybe predict that maybe as interest rates rise, we might be, exiting out of those more so, or investing more of them because we may think they're going to drop, but we don't have a definitive one right now. It's more so we're going to see where the market's at when we rebalance and then make decisions from there.
Okay, thanks.
And there is one question from Omar, an alum. He asks, how does BAM define value? If you define value primarily as low price to book value, would you be concerned with a new wave of technology and inflation, as mentioned before, to cause book and market value to vary dramatically and not accurately measure value to shareholders? Are there other metrics that mitigate this concern?
So can you repeat the question, Brian?
Yes. So the question is in the chat if you want to reread it. The question is, how does BAM define value? If you define value primarily as low price to book value, will you be concerned with a new wave of technology and inflation, as mentioned before, to cause book and market value to vary dramatically and not accurately measure value to shareholders? Are there other metrics that could mitigate this concern?
I'll try this one. So I think that in the way that we view our strategy, we do look at like price to book, we look at price to cash flow, price to earnings. We use a combination of these factors, and more so like, yes, we do screen for them, but we don't solely pick based on that. I think that, you know, what happens beyond that, like with our BAM 13 system, our financial analysis of like the deep dives into the companies, and we look at analyst reports, earning calls, all the good stuff that Colin talked about today. That, along with like our own DCF models, we're able to really kind of put a holistic view of the company and make sure that, one, yes, it does match our view that it is valued appropriately, or in most instances, we were able to find what we perceive as like undervalued companies. And they're also implementing that growth aspect to it. So it's a little more complicated than looking at a few metrics to determine yes or no, it does match value, but we have to really deep dive into potential companies that we were looking at.
I have a quick suggestion. Since you emphasize using the ISS governance score in your screening process, so when you presented the two stock valuation, do you want to include that measure for the two examples that you presented, the ISS score, the governance score for these two? So the one that you pick will have a lower ISS score, which means better, and the one that you didn't pick, you know, shows probably higher one.
Yeah,
like
it certainly does. That's actually a really good point, Dr. Yoon. I think we'll bring that to the team. But that's actually an excellent observation. Thank you for that.
Great. So are there any more questions? If not, I know we're getting towards the tail end of this. I'd like to, Professor Tancredi, do you have anything else that you wanted to go over?
I don't have any questions, but I'm humbled by the questions asked. We thought we were damn well prepared. We had everything covered, and then the judges asked questions that we weren't prepared for. So this is going to be very helpful for us to expand our Q&A prep for the competition. The submission is a video recording, so that's pretty much done. But the Q&A is live, so everything you guys just asked, everything that was discussed here, is going to be hugely beneficial to the team.
Can I point something out? The presentation was very good. I like the coordination among the team members and how they rise up to the occasion. You know, keep that up, stay with that. And also maybe specialize, you know, so fixed income, you know, Adam would jump in, you know, the asset allocation, Colin or whoever, you know, so that if something comes up, you're ready, or there's one or two who specialize in the what field and they can take on the questions from the judges, or maybe add to the response of another colleague. But again, it was very good. I mean, this is a compliment, by the way, not a criticism. It really is a compliment. It was very well done.
Well, you know, when Mutasar gives a compliment, that's like serious stuff. I'm worried now because I think Cash is getting ready to ask something.
Well, my question was, I'm sorry that I came late because I had a plumbing problem. I had the plumbers to fix this. By the time I got here, the presentation was over, so I didn't hear enough of what was the process. The first thing, because there was a discussion of value, and my question was, how do you define value and how do you screen the companies for value? What is the metrics that you use to say this is the value of stocks versus growth of stocks? I think this question should be answered by Mutasar.
Well,
So does anybody on the team, so Dr. Cash is actually asking the question. So does anybody want to revisit that issue of how we define value versus growth?
Yeah, so I would say it basically comes in a couple places. So it comes in on our screen. I don't know if you want to bring up the presentation, Andrew, or someone, but it essentially we are looking at price to book. We're looking at price to cash flow and price to earnings growth. So the top part of the screen is really working towards eliminating companies that maybe are very high growth and are just maybe overvalued in terms of the peers. So that's a good way that we can kind of mitigate. We sort out those higher growth firms. And I think another thing, and when we look at the BAM 13, I think that we have some metrics there as well. We look at just kind of I lost it. Maybe someone can help me out.
We're going to wrap up at 1, so we have a hard stop there. But let's get out of the screen share. Let me make sure we actually answered within our family. We have a good answer for that question, so we'll practice as a team. The answer is the price to book is just one metric. We also define value based on price to earnings, price to cash flow, and we use that in the screening process. At the next level, we also look at the PEG ratio as a balance. You know, you could have high growth companies, but there might still be, you know, good value companies because the PEG ratio is low. So those are multiple screens, multiple processes we go through as we define value. And at the final phase, we do a DCF. So our definition of value is a multifaceted in those areas. So that's the answer that I know my team knows, but they're tired.
Yeah, so we will end the presentation here. And final announcement is the SMIC application is open until December 9th. So if you liked what you saw here and want to be a part of it in the coming semester, please look into the application. We'll try to post it in the chat. Thank you to everyone for joining.
And,
thank you to the—
just a quick comment on that point you just made. I guarantee you, you will learn more than you've ever learned before. If you don't, I'll buy you lunch.
When is the lunch?
At 4 for 4 Wendy's, Cash.
Is it virtual or real?
All right. So if you need to head out to your class or to your next lecture, feel free to head out. Thank you, everyone. Once again, we're really honored to have been able to host it this year.
Good luck.
Great job, guys.
Thank you. Good job.
Thank you, guys. We appreciate it.
Absolutely. Very good.
Okay, class, I'll see you tonight at 7.
We'll see you.
Bye. Thank you.
Good luck with the recording, Sandra.
Bye, everyone. Thank you.
Yeah.